half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man with Annabelle Droulers.
And our top stories. Asian stocks sink, led by Japan, as fears of a deeper US economic slowdown rattle traders around the world. Treasuries surge as traders bet big on aggressive Fed rate cuts. Also ahead, China unveils a 20-step action plan to boost domestic consumption, financing support for small businesses and tax deductions. Plus, inside Adani, Bloomberg gains unprecedented access to the Indian conglomerate's leader as he cements a succession plan and battles fallout from the Hindenburg short seller attack.
In fact, basically these Hindenburg issues of this last year was Adani Group history is the highest performance.
All right, it is Monday morning, and you are feeling that right now what was a blowout week last week looks like there's no let up in sight here right now. You take a look at what stocks are doing here this morning, and we continue to see this global rally, well, I should say sell-off, extend itself here today in the Asia Pacific. Japan, we're talking about the Nikkei and Topix are both set for entering into bear markets here today, and Taiwan just coming online, and we are seeing massive declines of 5% down this morning. It all comes on those U.S. growth fears that Annabelle had just talked about here. That U.S. jobs report did not help. Right? When we talk about a 4.3% print on unemployment, that certainly does raise the VIX, and it raises the Nikkei VIX here this morning as well, as we continue to see, and question whether the Fed is making a policy mistake. Should they have actually cut last week is one question a lot of analysts are asking here. And you have more economists, J.P. Morgan, Citibank, revamping and calling for deeper cuts now from the Fed. 50 basis points, they're saying, for September and November. That's the fear across these markets now, that we've shifted basically from a hard landing scenario. And that's why you're seeing that flood into treasuries, into sovereign bond markets here right now. Your Aussie 10-year yield is down some 3 basis points, but that JGB yield on the 10-year is down some 11 basis points. That basically is dropping to the lowest levels we've seen since May. It looks like we forgot that the BOJ hiked last week already with these moves here right now. And then you have to watch, of course, some of these oil markets and commodities as well, with some reports from Axios saying the U.S. told the G7 that Iran may attack Israel in the next 24 hours. So that might be also something that we have to keep in mind. We're watching the Aussie 3-year yield as well, seeing some big declines. It's really what we've been seeing in the U.S. Treasury yield curve and the like, right? When you saw that drop on the U.S. 2-year yield to those 2023 lows, we continue to see that flood and safe haven flows coming to treasuries here. 381 for your U.S. 2-year yield. The 10-year is at 373. So most of the curve, except for the 30 right now on your screen, is below that 4% level here right now. In fact, that 2-year yield is at the widest gap we've seen with the Fed's benchmark rate since the global financial crisis or so, or during the dot-com crash. So that's what the market's really pricing in here right now, that recession risk. You take a look at what we're also taking some big moves across Japan, as we talked about. We had that circuit breaker. We come back online, and we continue to see quite a bit on the financials, the insurance and the banks, which were really the darlings, leading up to this BOJ decision last week, now faltering once again for another day. We're seeing double-digit declines on those indexes. But yeah, Mitsubishi UFJ, that's the one that saw significant declines here. We're down some 12% here right now, but paring back some of the losses, it was down about close to 20% just now. But yet, Apple suppliers in focus. To add on to all this storm, you have Berkshire Hathaway also cutting their Apple stake by nearly 50%. That's what we learned over the weekend. So we're watching very closely some of these big tech names here as well. Your approach to the open in China is looking like this here as well. We're watching, of course, the moves of the yen. So now that we have yen trading on 146 level, certainly that surge continues on that currency. And we're basically seeing the renminbi, the offshore rate at least, the strongest level this year. Can we continue to see those gains here this morning? You take a look at that. You're still seeing that CGB rally taking 211 for your CGB 10-year yield, and 712. We just broke below that 713 level for dollar China. But futures are pointing red this morning, Bill.
Yeah, certainly very much a picture of weakness across the screen here. But let's bring in our Asia equities reporter, Winnie Zhu, joining us from Tokyo this morning. And Winnie, of course, you had that BOJ move last week, and you've got perhaps investors that are readjusting to these expectations around the BOJ, the pricing on the Japanese yen. But where do we go from here, and how long does the weakness persist?
Right, so for the short term, we're still likely to see a lot of selling pressure. As you can see what's going on today, it really caught a lot of investors by surprise as well. Some say this is just a continuation of a free fall. Some say it's a storm. So, there's a lot of panic in the market. And you see all these like bearish signals coming in with the U.S. Economic slowdown, worries around that area, and also just the appreciation of the yen and also the volatility of the yen. So as our reporting showed, that the yen is likely to potentially appreciate to the level of 140 against the dollar. So that is still going to have some pressure on Japanese stocks. So, and also with the unwinding of yen carry trades, that's still something that we're still likely to continue to see. So, just now I talked to Mizuho that said that we're going to see a 2 to 5% of moves in the yen and in Japanese stocks in the short term.
I want to bring in Mark Cranfield now, our Bloomberg analyst strategist, joining us out of Singapore. I think, Mark, it's interesting, right? Just how difficult is it to really game this if I'm a trader here right now, whether it's risk assets, whether it's safe havens? Because markets, leading up to this was really, in some ways, front-running already the Fed's first rate cut. Is this just really a reset from what was really just a frothy market, or are we really talking about capitulation now, panic?
There's certainly some of that going on, and we're in a way we're in the worst kind of scenario, because you've got a lot of investors here questioning whether policy mistakes have been made, both by the Federal Reserve and possibly by the Bank of Japan as well. And when you're in that kind of mindset, it's just sell first, ask questions later. So the unemployment data that came out last Friday was the worst kind that the Fed could have had, because already, as you were saying earlier, people are questioning whether they made a mistake by not already lowering rates in July. And now traders are starting to price for the need to do a much bigger rate cut in September. The ideal situation for the Fed would, of course, been that they've got everything under control. The slowdown is going to be a nice soft landing. They can go with a 25 basis points rate cut and they can take their time. Everything is now up in the air. And we saw what happened when the Federal Reserve started raising interest rates aggressively in 2022. They had to go by 75 basis points a time in order to catch up, because they'd allowed inflation to get too far ahead. Now investors are thinking they're allowing the slowdown to go too far, and they may need to do large increments of rate cuts. So we're in a situation where Federal Reserve speakers will need to reassure investors very quickly that things aren't as bad as the market is pricing, but it's not going to be easy. When you see the extent of the sell-offs, as Winnie was saying there, it's become panic mode, especially in places like Japan. And that is not an easy place for the central bankers to come in, but they will need to come in quickly and calm people down. Otherwise, this will turn into a complete slump across asset classes.
Mark, how much do you think also the story around Berkshire is adding to the angst today? Because, of course, over the weekend we saw them cutting their Apple stake by almost half. The reasons for that, it could just be around tax. It could be something to do with China. It's not so much clarity there, but how much is that adding to the anxiety this morning?
Well, it certainly isn't helping. I mean, what Berkshire is doing in reducing their stakes is something that's been going on for a while. They just didn't suddenly start cutting these. It's a story that Bloomberg has been covering for some time. But on a day when people are looking for reasons to be out of the market, this will assume a much greater importance than usual. It's one of those typical examples where on a bad day, ordinarily bad news becomes extremely bad. So people will certainly add more weight to that. And also the story that Goldman Sachs have now increased recession odds to 25%, which still means that it's a low probability. But the fact that they've done it, and they're a high-profile person, they've done it over the weekend, again, that will add to the anxiety in what people is fueling these kind of sell-offs today. So anything which makes the situation worse is not going to be good.
Mark, thank you. Our MLS strategist, Mark Cranfield. I also want to thank Winnie Xu, our Asia equities reporter, joining us out of Tokyo, just really talking about the sell-off that we're seeing on the topics as well. as the Nikkei here today. But yeah, as Mark had mentioned, right, that Goldman call was quite interesting, right? They raised the arc 25% of a recession, but they said, look, there's still warning behind this. Let's not get too ahead of ourselves. That it's still, the economy is still looking pretty good. But all these other Wall Street banks are really quite quick to talk about aggressive, deeper cuts, right? We talked about JP Morgan, we talked about Citi. Both are saying 50 basis points for September and November. And you got to wonder, does this harken back to what we saw earlier this part of the year when we were calling for up to 6 cuts for this year?
Absolutely. Think about the pricing coming in as 6, 7 cuts at the start of 2024, and then it was that repricing. Now perhaps we're seeing it again. But of course, Goldman, yes, that 25% chance of recession, it's up from 15%. As you said, they're still saying the economy is looking pretty healthy, but not quite as much cuts forecasted that you do see there in that chart. You've got the likes of JP Morgan, Citi, 50 basis point cut in September and November. All of them as well saying a quarter-point reduction by the end of the year. All right, let's get more on that now. Bring in Xinyi Sun, head of fixed income ETF portfolio management at Mirae Asset Global Investments. And Xinyi, what's standing out to you this morning, really around the jobs report from Friday, changing expectations for recession, rate cuts as well ahead?
Yeah. I think from last Friday, the market has been quite volatile. And this morning, the equity markets, also the bond markets, has been reflecting people's fear about the recession. So I think the main topic people are discussing is because the employment rate has triggered some rules. So if you ask me whether I think it is recession now, I would say no. However, if we look at unemployment rate, it's increased from 3.8 in March and until 4.3% in July. You see the momentum is quite strong. So I think it is time for Fed to react. So from my view, I also would agree if Fed should employ a rate cut in this September, and 15 basis points is what they should do. And also, I would expect one or two more cuts in November and December.
I mean, what are you seeing in terms of ETFs and the flows right now? I mean, it seems like the knee-jerk reaction right now is to basically flock to U.S. Treasuries.
Yeah, indeed. So global-wise, we see cash is less king, and we see strong inflows into equities, and recent weeks, very strong inflows into bond ETFs. Especially worth to mention for our products, locally we see people has very strong interest in income strategy because they see the market is very, very volatile. They need to a stable cash flow to establish their investment strategy. And our newly launched U.S. Treasury ETFs has seen very strong investor demand. It has become the largest U.S. Treasury ETFs listed on Hong Kong Exchange. Also, we have a cover call strategy. The AUM now is 6 times compared to its launching size.
Yeah. Is there a risk of really overshooting this right now? I mean, we talked about this Goldman call. Maybe the risk of a recession has increased, but they're not saying that a hard landing is imminent right now. I mean, at what point do you think this has gone too far?
Yeah, I think for me, because I think now it is not recession now. We do see the U.S. economy is slowing down. But from slowing down to recession, I think we need still some time to observe. We need some more data to support, because if we just look at the trigger of some rules, the unemployment rate, there's many moving factors are impacting the employment rate. Because after the pandemic, the labor is quite tight. The lower supply resulted a relatively lower unemployment rate. And now with the immigration and with a surge of labor supply, we see the unemployment rate is going up. I think overall we still need some time to say it is a recession now.
So then, taking us to what's our question of the day, are traders right to be betting on bigger Fed rate cuts then at this point in time, given what you're seeing around the labour market?
I think the market is always right, but I may have a slightly different view, given I don't think it is the correct timing to trade recession, but I think market may position a little bit before that.
Where's the best place to really hide amongst all this right now? I mean, you talk about maybe the belly of the curve right now. Yeah.
Yeah, I think I still favor the front end and the belly of the curve. Given the long end, there are a lot of factors impacting the levels. Also, I think around 4% level is already quite low, given we see the long-term inflation will not be as low as we see before. And the front end and also the belly of the curve, I think it will benefit from the Fed curve and also avoiding excessive duration risk and volatility.
We're actually just getting, of course, so many breaking news headlines this morning, but the latest one just crossing is that we're seeing Asia high-grade dollar bond spreads widen the most in 22 months. Is this an asset class that you're watching at all?
Yeah, I think Asia high-grade bond definitely it's a big asset class we are eyeing. However, I think recently the credit spread is quite tight, so I wouldn't say it's like super attractive. And as we're heading into August, the global liquidity is relatively light. So within that asset class, I think I would look at more looking for more relatively value opportunities. And also, as we are heading to the Asia earnings season, so we should look at those names with improving fundamentals.
What's the safest place to go to? Is it U.S. Treasuries or CGBs right now?
I think in terms of the certainty, I think CGB, I have quite strong conviction the level of CGB would go down quite a lot, given you see the quite weak PMI data, and with the Fed rate cut, I think PBOC would be able to do a lot more. So along the curve, I think the front end 1-year CGB is trading around 1.4 level. It is already quite low compared to the 7 days repo 1.7. So I think I would recommend more to, I think on the 10-year level of the CGB, we would see it go down to below 2% towards the end of the year.
So you're not worried about any intervention sort of risk?
No, I think for PBOC, they care more about the shape of the curve rather than where the level it is. And I believe they will ease more aggressively.
Xinyi, it's great to have you. Xinyi Sun there, head of fixed income ETF portfolio management at Mirae Asset Global Investments. Of course, we're checking what's been going on across these markets. There's just too many milestones to talk about here today, but U.S. futures continue to see sizable declines across the board, whether it's the NASDAQ, whether it's S&P here right now. There you go. NASDAQ 100 futures were down 2.5%. This is after, of course, we entered into that correction last week as well. We're at 144 levels. There you go on dollar yen. So this unwinding of the carry trades continues for another day, and you normally don't see a strengthening of 1% on the yen like that. And Bitcoin tumbling here. We are seeing declines as much as 10% just now. We pare back just a bit, but we're trading around that 54,300 level here right now. We're also counting down the opens of trade in Shanghai, Shenzhen, and Hong Kong. Stay with us on this big markets day. This is the China Show. Your Hong Kong pre-market just opening up here this morning, and it looks like they are joining in on this global equity sell-off here this morning. And you continue to watch those growth fears continue to be a bigger narrative across these markets. And the Hang Seng is down close to 360 points at the get-go as well. So, yeah, CGB yields, you still see that rally. We're at 210 levels here right now, and we're going to watch very closely what happens for the whole rest of the curve here. But 712.60, that strength in the currency still persisting here today, Belle.
Yeah, and of course, watching for any sort of market reaction that comes through to China's government issuing a 20-step plan to boost consumer spending. That's as weak domestic demand continues to weigh on growth. Our China correspondent Min Min Lo joins us with more. And Min Min, it's a new action plan, but it's not the first time, of course, we've heard about measures to try and lift consumption. Is this something that's going to actually have long-lasting consequences?
Well, it's hard to say. Well, the plan is pretty specific in terms of which sectors they want to promote, because they're looking at exploring the potential of catering and accommodation services. They're looking at domestic services. They want to foster new types of consumption in e-commerce, live streaming, e-sports, unmanned retail stores, also new types of travel like RV camping and yachting, for instance. And then there are also financial support as well, for financing support for small and micro enterprises enterprises, credit support for households for certain types of service consumption, personal income tax deduction as well. But as you said, the question is how big of an impact. What's clear is the government is acknowledging that this is a big problem, but with the property market still in the doldrums and most of people's wealth tied to it, it's hard to say, by stopping short of providing cash handout, it's hard to say how much of a stimulus this would be.
All right, Min, thank you. Min Lo there, our China correspondent with the latest here on maybe some more meat in the bones when it comes to the consumption recovery and what policymakers are looking at. We're taking a look at what it comes to what's going on, of course, these markets here, and we're continuing to watch what goes on across risk assets, and we're continuing to watch when it comes to the renminbi. So it was interesting here what we saw in the FIX just now. It was actually weaker than the offshore renminbi spot, and the first time since November since they have set it at that level or around those levels here. So certainly that's one to watch here today. And of course, we're watching very closely how this sell-off continues. Relatively speaking, the Hang Seng looks a little bit better than the rest of Asia, given just the massive declines we're seeing in Taiwan and North Asia here this morning. And we continue to see, of course, that currency continue to strengthen even after that fix. 712.66. Plenty more ahead. This is Bloomberg.
Huge amount of selling pressure that we're seeing this Monday morning here in Asia. Really standing out, of course, GMM function. All of these statistically outsized moves you've got in equity markets, Taiwan, Japan, both of those down more than 6%. But it is a bloodbath coming through as we see that bond market rally extending here. Again, huge drop in yields across the curve. Trading volumes, another way to express this. If you take a look at the AVAT function here, you can see that trading volumes are around 95% higher than they would be on a typical 20-day moving average basis, Yvonne.
Yeah, I mean, it's basically a lot of falling knives right now, and markets are really just really unwilling to catch anything here at the moment. That's why you are seeing, as Mark mentioned there, sell first and ask questions later. In terms of your agenda and what to look out for and what the pre-market is looking like in Hong Kong, it looks like we are joining in on this sort of panic Monday that we're seeing here in some ways. HS Tech is down 1.5%. We have the open coming up next. This is Bloomberg. Welcome back. You're watching the China Show. We're counting on the open of markets. And yeah, you kind of had to close your eyes and watch this day today and how it all unfolds because, after what was quite a whipsaw we've seen in market sentiment in just the last week, doesn't seem like we're seeing any signs of any sort of floor being put across these markets. And it's been just volatile overall. When you look at how stocks are selling off, there's a big drive down in Treasury yields and sovereign bond yields. Dollar is also down across the board. So all risk assets certainly are seeing some sizable moves this morning, Belle.
Yeah, that's right. And it's that big unwind of the carry trade that's coming through too. That strengthening you're seeing this morning in the likes of the offshore yuan, the Japanese yen, the Mexican peso as well. But this is the start of trade here for mainland stocks this morning. And the question is how much they're going to be joining in that global sell-off that we have today. We have the CSI 300 here coming online. It is to the downside this morning, though, as we said, not quite that same extent of the sell-off that you are getting in other parts of the market, given those changing expectations around the Fed. Did they miss the window for a soft landing? That's certainly one of the questions in front of investors this morning here. So what you've got at the start of the day is the CSI 300, as I said, down around 0.7%. Most markets in the red here today. You've got the likes of iron ore, though. It is actually gaining the Dalian contract there 1.5%. So setting it a little bit apart from what we see in global commodity markets. The likes of Kweijiao Motai, for instance, again, just a little bit higher. Ping An Insurance unchanged. So are we really going to see those same sort of moves? Hong Kong could be a bit of a different story. Let's bring up that dashboard here and take a look. Yes, so the sell-off, a little bit more extreme you're seeing in this market. The Hang Seng down 1.7%. Same for the HS Tech here today. Tech really is bearing the brunt of a lot of this. It has been this big question mark. How much we've seen that big run-up in big tech in the US, how much those valuations are justified. Again, these expectations around what the Fed does next, these recession fears as well. We just had Goldman Sachs, for instance, upgrading their recession forecast for next year, now seeing a 25% chance of a contraction on the horizon from 15% earlier. So again, Hang Seng faring a little bit more worse than what we see in mainland markets. Let's bring out some movers in particular, as we said, that focus on Apple again today. This is something else that's adding to some selling pressure. We saw Berkshire Hathaway cutting their Apple stake by almost half in the second quarter. Cash pile for Berkshire again at a fresh record here, but we are seeing weakness coming through in Apple suppliers in particular. And you've got these ones here that are listed in Hong Kong and mainland China. What else we're tracking? Consumer stocks. This is quite a different story for mainland China today, but we did actually see mainland China unveiling a 20-step plan over the weekend to try and boost consumption. Of course, we've seen these sort of policy moves in the past, but this one very targeted on certain sectors. The question, again, is whether we see any sort of gains in those stocks here, but it is that story, Yvonne, of a broader weakness across the screen.
Yeah, it's hard to find individual names, although even some that have earnings impacts, you're seeing basically a multiplier effect here really on just overall this macro sort of growth concerns and the like. Let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage here right now. And Garfield, I'm going to take a look at this U.S. two-year yield. I mean, we already tumbled by half a percentage point last week, and we continue to see this rally into bonds. I mean, how are you looking at the price action right now?
Well, the bond market is pricing for a recession severe enough that the Fed will cut rates by 50 basis points when it starts its rate cutting cycle, which seems potentially overblown. So the last two times that the Fed cut rates by 50 basis points at the start of a cutting cycle was in 2007 and in 2001, very beginning of 2001. So, and those were some very severe recessions that the US economy ran into. That's the bursting of the dot-com bubble and the start of what ended up being the global financial crisis, although it took quite a while to play out in that case. So the bond market, that's what they're seeing. They've been waiting in a lot of ways, bond investors, for precisely this sort of opportunity. The assumption was always that when the Fed breaks the economy, it will break it badly enough that you'll get a very, very strong bond rally. We've got a very strong bond rally. The one concern potentially for bond investors is that so far, although the economy is slowing, it's not clear that it is heading for a so-called hard landing.
Garfield, you're writing this morning about the connection that you're seeing between cryptocurrency prices, Chinese equities. Can you tie that together for us, and also talk to us about the national team in China and whether we can see that adding any element of stability?
Yeah, well, I mean, the crypto sell-off, that's a highly risk-sensitive sector, very leveraged sector, and what's clearly been going on across markets over the last couple of days is that a bunch of leveraged positions in particular are getting blown up. You borrow money to buy something. If it comes back down, you have to sell it as fast as you can to avoid taking losses or to avoid multiplying your losses on those leveraged positions. You look today, one of the other things that stood out for me was the Mexican peso dropping rapidly at a time when most currencies were more or less supported against the US dollar, except the yen, which is on its own tear. Mexican peso, that's a carry trade. That's leveraged. That's getting blown up as well. So when you have those sort of positions getting blown up, that underscores the potential that you're seeing forced selling in a range of markets. You're seeing basically capitulation. Investors that have been holding on to positions, maybe, or even there was some talk that early last week, that we had some appetite coming back in for Japanese equities because the thinking was that the worst was behind them, both as far as the yen gains had gone and as far as some of the other factors. So then you get people pushed back out of those positions. There's turning then to China. There is some thought that the national team will come in to limit the damage in China. Certainly you would think that the Chinese authorities would prefer not to see equities there join in the rout that's broken out across Asia. You could also argue that China equities should be somewhat immune because a lot of people already exited their China positions, and there's not many people that are sitting on profits that they might want to take to help them get over losses elsewhere. But be that as it may, the Chinese authorities will be sensitive about the idea. They don't necessarily want to see their markets suffering in the same way. So you could get the national team coming in. You could get investors are going to be looking for signs of stabilization, signs that the rout has tailed off. So if Chinese stocks, which have started not too far down, if they start to come back up, that might spread across the region and sort of thought, well, perhaps the worst is over. I'd be more concerned right now with today that most investors would look past the China situation unless it also takes off to the downside. If we get stabilization in China, that's likely to be seen as just a China issue. If we get the national team staying away, or if we get them being overwhelmed, then that would help to set off some fresh waves of selling in other markets around the region.
And indeed, to your point, Garfield, there we've actually just seen the CSI 300 turning positive. So again, that question mark really around that stability, and is that afforded today? That was Garfield Reynolds there, who leads our Markets Live Asia coverage as well. Just checking what is joining in, certainly on the sell-off, is the Taiwan Stock Exchange this morning, because you're down around 7% now. This is the lowest point we've seen for the index, going all the way back to 1976 at this point in time, really adding to that selling pressure on Friday because we saw record foreign fund outflows. It's that question mark really around that AI boom, and Taiwan, of course, has been the key, or one of the key beneficiaries of that.
Yeah, it used to be you could mention the word AI and only stock prices would fly. I don't think that's the case anymore. And whether, AI does deliver for big tech, that certainly is still the key question for these markets here right now. But yeah, that brings us back to, I believe, 4-month lows for that benchmark there. But yeah, dropping the most since 1976. Let's get a little bit more news now. When it rains, it pours, right? We're hearing some reports. Axios is reporting that the U.S. has told the G7 that Iran may attack Israel in the next 24 hours. Our Asia senior editor, Bill Ferries, is with us so far. Bill, just tell us what we know at this point, and what the U.S. is preparing for.
Well, there's been expectations of some kind of a reprisal from Iran or its proxies ever since about a week ago we had those killings of senior leaders in Hezbollah and Hamas. The U.S. apparently telling G7 allies that an attack could come within the next 24 to 48 hours. The U.S. has moved additional ships and fighter jets into the region, and it's kept an aircraft carrier that was scheduled to leave in the area. Israel, of course, has been bracing for an attack for days now. What we saw the last time some of this unfolded in April was a fleet of drones and some missiles coming directly from Iran. But we know from our reporting that Israel is expecting an attack that could come on multiple fronts. That means it could come from the north and Hezbollah based in Lebanon. It could also come from Houthi rebels in Yemen, as well as a direct attack from Iranian soil. So a very tense situation in the Middle East, and the U.S. trying to beef up forces to help Israel defend against any potential attack.
And, of course, the question marks around the foreign policy of where the U.S. goes next. Kamala Harris is said to be meeting with a variety of vice president candidates or potential picks. What's the latest there?
Well, the clock is ticking on Vice President Kamala Harris's decision. She, according to her campaign, is scheduled to be having a rally with her vice presidential pick on Tuesday, and then beginning a 7-state battleground state tour around the country. So she has basically, at this point, we're talking about Monday and part of Tuesday, so perhaps 36 hours or so. She met with 3 potential candidates over the weekend in Washington. That includes Minnesota Governor Tim Walz, Pennsylvania Governor Josh Shapiro, and Arizona Senator Mark Kelly. Those have been seen as the 3 leading candidates. We think she had virtual calls with some other potential candidates, but those 3 seem to be the ones she's leaning towards. We're just waiting for a final decision now, perhaps Monday.
That was Bloomberg Asia senior editor Bill Ferries there. And up next, we've got special coverage of the Indian conglomerate, the Adani Group. We're going to be hearing exclusively from Gautam Adani about the impact of the Hindenburg short seller report on the company and his succession plans. More ahead. This is Bloomberg.
All right, we're taking a look at markets here right now, as we talked about here when it comes to onshore rates. And it looks like right now we have flipped to see more gains here. So, yeah, are we seeing some signs of maybe the so-called national team stepping in here today? Maybe. But, you take a look at that, how the Hang Seng's doing. We've pared back significantly in terms of the losses in the last just about 13 minutes or so since things opened. So, yeah, we are maybe seeing a bit of people taking shelter in these markets, given the backdrop that you're seeing, right? Nikkei 225, we're down still some 5%. And we are on the cusp of entering into a basically bear market for the Nikkei, as well as the topics here today. ASX 200, we're also down about 200 points or so here. Nifty futures are pointing negative here this morning as well. And today we're beginning our special coverage of one of India's biggest and most controversial business groups in our exclusive interview with its billionaire founder, Gautam Adani. Now, he reveals how he's putting into motion one of the world's largest and most challenging succession plans.
Yeah, and that's even as the Adani Group continues to face fallout from the short seller report that last year wiped $150 billion from its market value. Adani also dismisses allegations that the conglomerate's dominance in key sectors of India's economy is due to his relationship with the Modi government.
It's been a volatile few years for Gautam Adani. The Indian billionaire has built the Adani Group into a sprawling conglomerate that controls large and critical infrastructure projects in one of the world's fastest-growing economies. While it's made Adani one of the world's richest people, it's also attracted accusations of cronyism over his close ties to Prime Minister Narendra Modi, as well as questions about corporate governance. In January 2023, those concerns erupted onto the global stage when short seller Hindenburg Research accused the Adani Group of fraud and stock price manipulation. Though they denied those allegations, the report still triggered a $150 billion meltdown in shares of the group's listed firms and cast a shadow over the company, just as it was eyeing a wider global play. The stocks have since then pared most losses, and the Adanis have tied up fresh lines of bank and equity financing and won a reprieve from India's Supreme Court. But fears linger as investigations by India's market regulator and the U.S. Department of Justice continue. It's with this backdrop that the 62-year-old founder spoke to Bloomberg's Anto Antony to say he's setting in motion a succession plan that will hand the running of his massive conglomerate in about 8 years to the next generation of his family, which he dubs the G2. Adani limited on-camera questions to succession. We asked him about the impact the short seller report and its aftermath had on this transition plan.
Mr. Adani, you said that the succession plan was conceived about 10 years back. Now the last 2 years incidents, the investigations, the Hindenburg report, has it affected it in any way, the implementation?
In hindsight, I can say that it is this incident makes family more together and work very hard to fight it back. And I definitely basically see that they have converted this incident into the great opportunity for family uniteness. Secondly, they work hard, and whatever corrections in each and every aspect of our businesses we have to do. And in fact, basically this Hindenburg issues of this last year was Adani Group history is the highest performance.
Many people attribute your business growth to how you strategize your company's priorities to that of the government's priorities, whether it is state or center. Is that something that you will ask the next generation to continue?
No, so that is basically group has decided, irrespective of the government. Okay, when whatever the government basically decide the priority for the nation's point of view, we always basically focus our business in that direction. And I strongly believe that when you basically business directions towards government priorities, you always basically get the tailwinds and not the headwinds. And that helps your group to grow faster.
That strategy has meant the Adanis now control big chunks of India's infrastructure, including ports, airports, and data centers. So the decision on how the Adani Group will be managed in the future will have ramifications beyond the conglomerate and the family.
Tell us about your succession plans. What steps are you putting in place to ensure that this goes on smoothly for the investors, the family, as well as the company?
Succession is a very, very important for the business sustainability. And it must be organic, gradual, and a very systematic. Succession is not one of the events, but it is a long-term journey. And my plan of succession started almost a decade ago. And I gradually inducted our G2, Pranav, Karan, Sagar, and now Jeet. And the successions will be completed according to my planning in next 8 to 10 years. And all the G2 members of our family were given the best of the professionals' educations. They were also trained in the fundamentals of each and every businesses. They started as interns with our professional CEOs, and gradually they evolved into the leadership roles. Today, all of them looking after the different businesses, and I'm very satisfied with their progress. I'm really proud that all 4 of them are very, very hardworking and very grounded, and they enjoy their work, and most importantly, they all still hungry, which is not very common among second-generation entrepreneurs.
What systems are you putting in place to make sure that the group continues to grow without any internal conflicts?
These integrations will never happen in the Adani Group. When I gave the G2 the options of independent businesses, they decided collectively that they want multiple businesses but one family. So they have a strong unity among themselves. The succession is all about both continuity and change, and it is a gradual process. This will ensure that the succession is seamless, is a smooth, and a sustainable. The structural succession plan is supported by a strong cultural values. Our values provide the glue that holds together our arrangement.
And once the transition is complete and once you have more time at hand, what would be your plans?
Ultimately we will retire and be more relaxed.
That was the Adani Group Chairman Gautam Adani speaking exclusively with Bloomberg's Anthony there. And our special coverage of the Adani Group continues all of this week. Tomorrow we're going to be asking Gautam Adani's eldest son, Karan, about taking over one of Asia's biggest logistics businesses and about claims that the Adani Group is too close to the Modi government. Also, our coverage culminating with a special report on Friday. That's at 11:30 a.m. if you're in Hong Kong, with an encore presentation at 7 p.m. That's 4:30 over in Mumbai, Yvonne.
In case you missed it, we just got that Caixin PMI services number that came out here, and actually stronger than expected. So we're talking about 52.1 print for July. So that is a beat from what economists were expecting. And of course, maybe showing a little bit more positivity than what we saw in those PMI numbers for manufacturing just last week as well. You're seeing just a little bit of weakness or a paring back of the gains that we're seeing in dollar China right now, but we're still holding around those 713 levels right now. We got plenty more ahead. This is Bloomberg.
All All right, checking in again on markets, and it is what's being called perhaps a full-scale capitulation here across the board. You've got Japan, South Korea, Taiwan, all at least 10% off their recent peaks. You've got the MSCI Asia Pacific Index less than 1% away from wiping out this year's gains, but broad selling here across the board as you continue to see that global bond market rally extending here. Yields that are dropping, big moves in currencies as well. You're seeing the unwind of that carry trade. You're seeing the likes of strength in the Japanese yen, Mexican peso, Chinese yuan, and you also have potentially some support for Chinese stocks coming through with those latest PMI readings, the private survey there, plus keeping an eye on what's happening in the crypto space. Bitcoin as well is slumping. But more ahead, this is Bloomberg.
Welcome back to the China Show. A look at the CSI 300 a half hour into the session. You got to wonder, is this the place to sort of seek shelter amidst all this sort of volatility that we're seeing across risk assets here today? We continue to see, as Belle talked about earlier, the MXAP Asian stocks are just less than 1% away from wiping out the gains of this year. And we're actually seeing, out of all that bloodshed, a bit of positivity on your onshore market. Shanghai is up close to about, what, 1/10%. Mind you, though, of course, we are talking already still, we already weakness in this market. Maybe, the likes of, Japan, North Asia are really just kind of catching up in some ways. But yes, you take a look at what's really driving this here right now. You got to wonder, is it really about the Fed discussion, the growth concerns? We also have earnings as well. But what's really going to be the bigger driver for the next few weeks?
Yeah, well, it certainly seems to be these changing expectations, not just around what the Fed does. Have they missed the mark here for a soft landing, but also recession fears that are surfacing. And you saw Goldman Sachs, for instance, upgrading their forecast for next year. Taking a look at what's happening, though, really is that extension of the global sell-off coming through. You see black boxes here a lot. That means that you're seeing an outsized move in a lot of these different asset classes this morning, really being led, though, by those big drops we're seeing across the board in equities here. Taiwan, for instance, we haven't seen this sort of drop going all the way back to the 1970s. You're seeing big losses in Japan as well, down nearly 6% at this point, and weakness in lots of different sectors. Financials, you've got it in tech stocks, lots of different corners of the market. What else we're tracking is that big move in bond yields that you've got today. That global rally is extending here. Again, big drops here across the board as we see those changing expectations. Some banks, some economists out there are saying that you could see a 50 basis point cut by the Fed as soon as September of this year. Currencies as well to track, because you've got the likes of the Mexican peso, for instance, the Japanese yen, the Chinese yuan, for instance. Very much a watch, that unwinding of carry trades. Commodities, again, just a little bit under pressure here, but just keeping an eye on what's happening in Korea's market today, because you've got South Korea halting selling orders. So again, the questions around just the magnitude of the sell-off, Yvonne, and where exactly we go from here.
Yeah, let's bring that question to our team. MLive strategist Mark Cranfield and our FX and rate strategist David Finnerty. Mark, I'll start with you. It seems like there's falling knives everywhere. Where best to hide right now?
Well, funnily enough, China is looking relatively subdued compared to all the chaos that's going on. It's a good time to be uncorrelated with other markets. So for a long period, particularly the last 2 years or so, we've seen China equities haven't been able to enjoy most of the rally that's been seen in global markets, and they've been underperforming pretty badly. Of course, they have the advantage as well that the so-called home team is quite likely to come in and try and support markets on a day like this, which some of the markets can't expect that kind of help. So the fact that a lot of selling has already taken place, China markets are relatively underpriced compared to others, there's less reason to turn really bearish on a market like that at the moment. So they will probably stand out as being one of the better performers. Doesn't mean to say they're going to rally hugely from here, but they will probably do better than most of the regional markets, where especially foreign flows are starting to reverse. Foreigners have probably been selling China quite a bit anyway. They may well be mostly out of that market by now, but they obviously were still heavily involved in places like Japan and Korea, and that still needs to unwind. So you're going to probably see a little bit more of that. At the moment, it's getting a bit indiscriminate. People are just selling stocks all over the place. They're not really being very rational about it. But amid all that chaos, China probably does better than most.
And how much do you think, Mark, this is also a question mark around the national team? For instance, if you take a look at some of the most popular ETFs or ones that had previously been associated with the national team, they are actually positive today. So is it that question around state support as well?
Yeah, I mean, China is well known for sending in help to the markets at certain times, and this would be an ideal day to do it. When the markets are likely to be under so much pressure, it would be a great opportunity. And the way in which, anyway, the structure of Chinese onshore markets is being heavily driven now by things related to the government funds, which are closely tied there, and even equity sectors, which are best supported by the government. It's increasingly becoming a very isolated market, which doesn't have an awful lot to do with what's happening in the rest of Asia or even the rest of the world. So that theme is probably something which people have got used to. So whatever you see happen in Chinese equities doesn't really give you much of a story about what's happening elsewhere. You really need to look at the more open international markets. And that's often why things like H shares underperform Chinese onshore so badly, because the Chinese H shares still have more foreign participation. And in many ways, they're a little bit more liquid anyway than the onshore markets.
David, obviously we've been talking about these unwinding of the carry trade. We continue to see big moves in the yen, renminbi, Mexican peso certainly is faltering in some ways. But I got to wonder, what's the outlook for these carry trades here right now? Is it really going to be Asia FX over LATAM currencies, for example?
Yeah, I think any trade that was heavily traded into, heavily long, should we say, it's just been unwound now, whether they want to be or not be. I mean, the hand is basically just being forced. The risk-off sentiment, which you're now seeing pervade throughout the whole market, and more likely will continue in the US based off the way S&P futures are opening up, that's going to permeate. So basically, yen is certainly be in demand, so any yen carry trades being unwound, and the same with renminbi. So unfortunately, it's all those trends are still going to continue, certainly in the near term. Of course, from the yen perspective, it's also got the benefit that it tends to outperform in risk-off scenarios, which obviously this is. So whether it be carry trade unwind or whether it be risk-off scenario, one way or another, the yen at the moment's gone from no one likes the yen to actually everyone loves the yen at the moment. We've said renminbi always helping, but certainly said from the other side of the carry trades, the Mexican peso and anything in LATAM, they're all being unwound at the moment.
And what about, I don't know how much you track it exactly, but David, are you watching the moves that we're seeing in the cryptocurrency space as well, and what that is feeding into market sentiment?
Yeah, well, I think it's certainly been caught up in this sort of risk-off scenario that you're seeing today. I mean, I said I think it will continue. If you look at my benchmark, always is US equities. Where US equities go, everyone tends to follow. And obviously, they sold off Friday and they'd shown some signs of weakness. But ahead of Friday's payroll, the futures indicating lower today. They bounced off the 100 DMA, the actual index did. If it breaks through that today, which it looks like it will, then you've got to think, OK, technically you're looking for maybe a Fibonacci retracement. The about 38.2% of the whole move, recent rally is really about 55,071, somewhere around then. So another 200-300 points lower than here. So that risk-off sentiment, I still think they've got plenty of room to run. If that happens, it seems that everything risk-off is losing, including crypto, which is getting caught up in this. So at the moment, you'd have to think, just while this sentiment exists, that the risks are skewed towards crypto's downside.
Mark, all these calls from banks, JP Morgan City is saying, look, we might need 50 basis points cuts for September and November now. And then subsequently, we need 25 basis points after that. I mean, it makes me wonder, right? It brings us back to the early part of the year where everyone was calling for, 6, 7 interest rate cuts from the Fed, which didn't play out. Does it remind you of that sort of time here right now, that maybe we're just overshooting all of this?
Actually, it's beginning to remind me more like 2022 at the Fed allowed the inflation numbers to go up too quickly, and they were very much behind the curve. And in the end, they started raising interest rates by 75 basis points at a time. Now investors are looking back at that and thinking, well, if the Fed is behind the curve again, then really we should be looking for really big interest rate cuts, jumbo-sized as they were described back then. So it's no wonder that traders are willing to price very aggressively in terms of how far yields can come down, because they've seen the Fed before in a situation where they were deemed to be behind the curve. They acted in a very big way. Doesn't mean to say that they're definitely going to do that again, but we still have 2 more inflation reports before the Federal Reserve meets in September. If those are soft numbers, the market will definitely be calling for 50 basis points, and they may even go further than that.
All right, that was Bloomberg's MLive strategist Mark Cranfield there, and our FX and rate strategist David Finnerty. And you can, of course, turn to your Bloomberg for more on this. You can go to TLive Go. We've got a special blog underway right now, commentary and analysis coming through from our expert editors. We'll have more ahead. This is Bloomberg.
All right, we're checking Japan assets here this morning, and really kind of what's driving this route really across global equities here. We're down some 5% once again, so I think it's one of the biggest 3-day drops we've seen for some time already for both the Nikkei and the Topix. And we are also set to enter bear market territory if we actually continue to end the day at this pace. 145 levels for dollar yen. You continue to see that Haven Bay played out for the yen here this morning, and we're down some 11 basis points for your 10-year JGB. Basically, the lowest that we've seen since May as well. We mentioned briefly here about what's going on in the Kospi, but yeah, sidecar was also triggered at 11 a.m. local time here because of that 5% drop that we saw in the Kospi. We'll see if we get any more updates on that market as well. For more, let's bring in our Asia equities reporter, Winnie Xu. She joins us live from Tokyo to talk really what's been going on from her end. And Winnie, any indication there whether the selling pressure will continue in the near term?
Yes, unfortunately, most likely. So, we've been talking to investors from Friday to today until just now, people are actually pretty surprised at how much the stocks are falling. Some say it's like a tsunami, like a storm, like a free fall. And when you look at some of the drivers, from like Friday, the worries around the U.S. economic slowdown, and also the appreciation of the yen and the volatility of the yen really are some of the key factors behind this. So as long as this is likely to stay for the near term, Japanese equities are likely to still face some of the headwinds. And we talked to investors, they see, we talked to Mizuho that said that we might see 2 to 5% of move in both yen appreciation and also the degree that the Japanese stocks will continue to fall. Some other investors say that once the yen break through that 145 level against the dollar, the appreciation might actually speed up to quickly touch 140 level, which will likely to weigh on Japanese stocks on the broader index level.
Yeah, certainly a concern for the Japanese exporters. But, of course, Japanese equities have been so much of a global investor favourite here. Does this really dent the appeal, do you think, over the longer term?
So I would say before we saw all the moves today, most investors were actually still quite upbeat about Japanese stocks because they look at, the strong fundamentals remain unchanged, and also the wage growth, as well as how Japanese companies have more pricing power. So some investors are still saying that once this broad sell-off is over, the sell-off that's led by the flows is over, investors are likely to be able to focus back on the fundamentals and the low valuations of Japanese stocks. And that's according to Goldman Sachs and JP Morgan. However, when we talked to UBS just a couple hours ago, they said that after the Friday move, they actually trimmed their forecast for the Topix and the Nikkei. So we'll likely be watching if some investors will start to turn in terms of sentiment.
All right, that was our Asia equities reporter Winnie Xu there in Tokyo, and we'll have up ahead our exclusive interview with the billionaire Gautam Adani as we begin a week of special coverage on his business and his succession plans with unprecedented access to the Adani Group and its next generation of leaders. More ahead. This is Bloomberg.
Well, Well, today we begin our special coverage of one of India's biggest and most controversial business groups in our exclusive interview with its billionaire founder, Gautam Adani. He reveals how he's putting in motion one of the world's largest and most challenging succession plans.
Yeah, that's even as the Adani Group continues to face fallout from the short seller report that last year wiped $150 billion from its market value. Adani also dismisses allegations that the conglomerate's dominance in key sectors of India's economy is due to his relationship with the Modi government.
It's been a volatile few years for Gautam Adani. The Indian billionaire has built the Adani Group into a sprawling conglomerate that controls large and critical infrastructure projects in one of the world's fastest-growing economies. While it's made Adani one of the world's richest people, it's also attracted accusations of cronyism over his close ties to Prime Minister Narendra Modi, as well as questions about corporate governance. In January 2023, those concerns erupted onto the global stage when short seller Hindenburg Research accused the Adani Group of fraud and stock price manipulation. Though they denied those allegations, the report still triggered a $150 billion meltdown in shares of the group's listed firms and cast a shadow over the company, just as it was eyeing a wider global play. The stocks have since then pared most losses, and the Adanis have tied up fresh lines of bank and equity financing and won a reprieve from India's Supreme Court. But fears linger as investigations by India's market regulator and the U.S. Department of Justice continue. It's with this backdrop that the 62-year-old founder spoke to Bloomberg's Anto Antony to say he's setting in motion a succession plan that will hand the running of his massive conglomerate in about 8 years to the next generation of his family, which he dubs the G2. Adani limited on-camera questions to succession. We asked him about the impact the short seller report and its aftermath had on this transition plan.
Mr. Adani, you said that the succession plan was conceived about 10 years back. Now the last 2 years incidents, the investigations, Hindenburg report, has it affected it in any way, the implementation?
In hindsight, I can say that it is this incident makes family more together and work very hard to fight it back. And I definitely basically see that they have converted this incident into the great opportunity for family uniteness. Secondly, they work hard, and whatever corrections in each and every aspect of our businesses we have to do. And in fact, basically this Hindenburg issues of this last year was Adani Group history is the highest performance.
Many people attribute your business growth to how you strategize your company's priorities to that of the government's priorities, whether it is state or center. Is that something that you will ask the next generation to continue?
No, so that is basically group has decided, irrespective of the government. Okay, when whatever the government basically decide the priority for the nation's point of view, we always basically focus our business in that direction. And I strongly believe that when you basically business directions towards government priorities, you always basically get the tailwinds and not the headwinds. And that helps your group to grow faster.
That strategy has meant the Adanis now control big chunks of India's infrastructure, including ports, airports, and data centers. So the decision on how the Adani Group will be managed in the future will have ramifications beyond the conglomerate and the family.
Tell us about your succession plans. What steps are you putting in place to ensure that this goes on smoothly for the investors, the family, as well as the company?
Succession is a very, very important for the business sustainability. And it must be is a organic, gradual, and a very systematic. Succession is not one of the events, but it is a long-term journey. And my plan of succession started almost a decade ago. And I gradually inducted our G2 Pranav, Karan, Sagar, and now Jeet. And the successions will be completed according to my planning in next 8 to 10 years. And all the G2 members of our family were given the best of the professionals' educations. They were also trained in the fundamentals of each and every businesses. They started as interns with our professional CEOs, and gradually they evolved into the leadership roles. Today, all of them looking after the different businesses, and I'm very satisfied with their progress. I'm really proud that all 4 of them are very, very hardworking and very grounded, and they enjoy their work, and most importantly, they all still hungry, which is not very common among second generation entrepreneurs.
What systems are you putting in place to make sure that the group continues to grow without any internal conflicts?
These integrations will never happen in the Adani Group. When I gave the G2 the options of independent businesses, they decided collectively that they want multiple businesses but one family. So they have a strong unity among themselves. The succession is all about both continuity and change, and it is a gradual process. This will ensure that the succession is seamless, is a smooth, and a sustainable. The structural succession plan is supported by a strong cultural values. Our values provide the glue that holds together our arrangement.
And once the transition is complete and once you have more time at hand, what would be your plans?
Ultimately we will retire and be more relaxed.
That was the Adani Group Chairman Gautam Adani speaking exclusively with Bloomberg's Anto Anthony there. And our special coverage of the Adani Group continues all of this week. Tomorrow we're going to be asking Gautam Adani's eldest son Karan about taking over one of Asia's biggest logistics businesses and about claims the Adani Group is too close to the Modi government. Plus, our coverage culminates with a special report that's at Friday, 11:30 a.m. if you're watching in Hong Kong, an encore presentation at 7 p.m., which is 4:30 in Mumbai.
Yeah, you take a look when it comes to markets here, and not much of an encore really when it comes to, well, I guess you're seeing an encore of what happened last week when it comes to mega cap tech in Asia. Nintendo, we're down some double digits there. It's not just the tech wipeout story, but really also earnings where, they missed in the first quarter operating profit. Second quarter demand also has been eyed on when we're going to see, of course, that new console with the Switch as well. But there you go. Hanhai Tokyo Electron, you're seeing 8% declines on some of these big cap names. Certainly we're watching very closely how this all plays out for the world of crypto as well. We talked about we were down some 10% at one point when it came to Bitcoin, and we're now paired off a little bit, but look at Ether. We're still down some 16%, of course, just given how sensitive this asset class is to basically any sort of macro news. That certainly is the big focus here today. And global macro movers is looking like this. It's basically your typical risk-off day. You take a look at how stocks are doing. We talked about we're close to wiping out gains of this year when it comes to Asian stocks here, and you're seeing that bloodshed across the board, whether it's Taiwan, Japan, South Korea, the like here. Maybe you're seeking shelter in China. We'll see. But yes, is diversification the place to go? Take a look at what bonds are doing. We have actually not seen that inverse relationship between stocks and bonds this pronounced for some time now. So certainly we're continuing to see that flood into safe havens like bonds. This is Bloomberg. 11:29 a.m. in Tokyo. Japanese markets are going to that lunch break. And yeah, it's time to digest really what's been going on across these markets here. Yes, we pare back some of the losses there on the Nikkei 225. We're still talking about a 4.5% decline across the board for the Nikkei. We're talking about the TOPIX entering close to bear market for both those benchmarks, I should say, as well. And the yen continues to strengthen, although we've pared back a little bit. So the dollar is coming back slightly a little bit stronger during this Asia session here today. But JGBs continue to be bought, as if they're pricing in cuts for the BOJ, which is absurd since they actually hiked last week as well. But what's really been hit, we talk about obviously the tech space, but really even the darling trades that we saw leading up to this BOJ decision, which basically started to sell off basically later on last week, was the financials, right? So, these were the key beneficiaries, of course, of a BOJ hike. Even those are selling off, which goes to show how broad-based the sell-off really is here. And maybe this rally that we did see in some of these, banks and insurers may have been a little bit overdone as well, Bill.
That's right. Yeah, it really is just that broad-based selling here when you take a look at the GMM function and see where we're at this point, and also just the broader dashboard that we have today, because it is very much broad-based, the pressure here. You mentioned what we're seeing in the tech space, for instance, what we've got in other sectors as well. You can see the likes of energy, for instance, down 1.8%. Consumer discretionary as well, off around 2%. Something interesting. We've got a luxury segment just coming up. But certainly it is that focus is what's happening in China. Is there going to be an element of stability that comes through when you've got that national team focus and more policy support measures on the way? Consumer-related stocks, tracking those this morning, Yvonne, and we actually are seeing just a little bit of green shoots coming through here, given as well what was announced over the weekend.
Yeah, that state council meeting where they rolled out a bit more of maybe details on how to really boost domestic consumption. This is what we heard, right? So they designated 20 steps to help the flagging economy, including fostering new types of spending. Now, the country has been seeing faltering consumer demand. That's really been dragged down by the slowing economy. And, one sector that's been affected is also big luxury as well. Names including Kering, LVMH, seeing sales by the region slow by as much as 14% in the last quarter. On the flip side, brands are seeing stronger spending in Japan as overseas travelers, many of them from China, take advantage of this weaker currency. Let's bring in our panel of guests. Jacques Roizen is China Consulting Managing Director at Digital Luxury Group. We also want to welcome Daniel Zipser, Senior Partner at McKinsey. Daniel, I'll start with you. Obviously, we talk about this phenomenon where, the Chinese are not quite spending that big domestically, but really they're heading abroad. What's the outlook of that? Is that a new trend, a new normal that we're seeing now?
Yes. So first of all, let me start with a headline message, which is Chinese have not lost their desire for luxury. That is very clear. I think there are two ways to tell the China luxury story. You can look at the mainland China spending, and you see a substantial decline for most luxury brands. Some of them actually declining double digits. At the same time, there's also the other side of the story, which is the overseas spending that you were alluding to. And in fact, it has in the first half of the year been above what we had pre-COVID. So the first half of 2024 has seen more Chinese overseas spending than it has in the first half of 2019. And that is quite remarkable and different than most expected. Japan is one, but also the recovery in Europe has actually been quite strong. So in that respect, I still would conclude we still see Chinese having a desire for luxury and still spending. Less than the past. I think that is normal in the overall economic context. But it's not the end of China luxury.
Not the end of China luxury, but Jacques, perhaps we can bring you in here. What are you seeing about these new trends emerging? Because there's also a lot of grey market activity that we see. New buying channels are emerging in the mainland as well.
So I think Danielle is absolutely right. The appetite is definitely still there. The first thing that needs to be well understood is that the current economic environment is not impacting all brands the same ways. The brands that have been focused on the Chinese middle class, that have been focused on new customer acquisitions for the last 10, 15 years, are far more impacted by the current economic environment in China than the ones that have been focused on delivering the pinnacle of luxury. And I think the results in the last few days of Hermès are a best example of how different brands have been able to protect themselves from the current environment. The second point is we're talking about the Chinese luxury market. And the Chinese luxury market is far more than the performance of luxury brands in China. Meaning, aside from the gray market that you were just mentioning, there's all this consumption that's taking place outside of China. And we're not talking about just any consumer. We're talking about the Chinese luxury consumers who pre-COVID were spending 2/3 of their luxury expenditures outside China. Now, obviously, during COVID, the only thing you needed to look at in order to understand the luxury market was the spending of luxury consumers in China. But today, that's no longer the case. And these people are slowly reverting to that behavior now that travel is resuming, to Daniel's point.
So Jacques, how do you see this all looking like? You know, if this is a trend that's here to stay, you know, is there a particular number that you could put up behind it? I mean, what percentage do you think we're going to see Chinese spending domestically, and how much percentage are we going to actually see heading overseas to buy?
We fully expect that over the next few years, Chinese consumers are going to go back to spending 2/3 of their luxury expenditures outside China, which is why we project the revenue of luxury brands to only grow at a low single-digit CAGR over the next 5 years in China, while consumers starts taking advantage again of the opportunity that they have to purchase goods outside China, which is, you know, in line with what they've done in the past. And that's why a lot of the narrative around a challenged luxury market in China is to a large extent misleading, because the revenue of luxury brands today should not be compared to the revenue of luxury brands in China last year, but to 2019 when the market conditions were identical from a traveling opportunity standpoint.
Daniel, how do brands go about meeting customers? Because we just showed a graphic there looking at the most successful brands in this market, Hermes, Chanel. They're ones that have been very successful at building long-term one-on-one relationships with the wealthiest consumers. If Chinese consumers are going to be buying outside of China, how do they meet them in the mainland to make sure that they're ready to meet them overseas?
Yes. So first of all, I think you're alluding to the key point, which is the purchases done overseas are targeted purchases. People do not travel and explore. While they're in the mainland of China, the brand perception is built, the desire is built, and when they travel, they will go and buy exactly like the brand they desire, and they take that decision ahead of their travel. So to your question, how are the brands responding to that? It's very interesting to see. There is a bit of a shift away from major capex investments. So we've seen less store expansion in the first half of 2024 compared to what we've seen last year. At the same time, we see an increase of brand events, PR events, where brand is being built, relationships with the high net worth spenders are being built, and the brands basically take a global view. And they say, well, we're investing in China, we're putting our marketing dollar behind, we're engaging with our consumers in China. However, it ends up in a different P&L, be it in Japan, be it in Italy or elsewhere.
You mentioned, I mean, a lot of these brands, they invested heavily in China during COVID.
Yes.
And now you're seeing that investment being pulled back a little bit, maybe to go to overseas markets. But what can they do domestically? Is it price cuts? Is that the answer that they can do?
Well, I think the price harmonization, has been going on for a number of years. Speaking of which, I think there's now a bit of an imbalance with Japan, given the weakness of the Japanese currency. But in large, I think luxury brands know how to bring the prices closer together. I think the key, but the overseas spending will not go away. It's part of the experience. It's an occasion. I travel somewhere, and yes, I make a bit of a bargain with a bit percentages, maybe less, but that's not the part. It's also the memory of returning from Italy. It's a memory returning of France. So I think what the companies have to basically get used to is that their marketing spending in China will be disproportionately higher, while an increasing part of the revenues will be from overseas.
Yeah, just that further premiumization, really, of the luxury market. That was Daniel Zipser there, senior partner at McKinsey, and Jacques Roizen as well, China Consulting Managing Director at Digital Luxury Group. Shifting now to a different corner of the market, very much what's happening in the crypto space in focus this morning, because you're seeing that sell-off really extending in Bitcoin prices in particular, with the likes of Ether, for instance, down 17% at this point in time. It's not just that story of risk aversion that's coming across the board today. It's also that story, perhaps, perhaps, given you had seen that run up in crypto prices when the election odds were favoring Donald Trump, someone is seen as a bit more pro-crypto, could also perhaps being unwound as well. But let's bring in our senior crypto editor, Ryan Weeks. And Ryan, what exactly is going on? Is it that sell-off you're seeing in global assets, or is it also just those changing perceptions around the US election and regulation there?
I think it's a bit of both. So yeah, it's been a rocky morning for cryptocurrencies. There's been a broad market sell-off. Bitcoin, the biggest token, fell more than 10% at one point, which is its lowest point since February. And Ether, as you mentioned, the second largest token, at one point had shed about a fifth of its value, and that comes just a couple of weeks after the launch of Ether-linked spot ETFs in the US. So pretty bad timing for investors. And in fact, last week I think Bitcoin had a 13.1% decline over a 7-day period, which is its worst 7-day decline since the days of FTX's bankruptcy, FTX being the fraudulent exchange founded by Sam Bankman-Fried. So a pretty bad week and an even worse day for cryptocurrencies. And as to what's driving that, yes, it's definitely linked to a worsening economic outlook, part of that broad stock sell-off, linked to tensions in the Middle East as well. But there are certainly some crypto-specific drivers. So the presence of these crypto-linked ETFs in the market can create a lot of momentum for the various different tokens, but the inverse is also true. So late last week, we saw one of the worst daily outflows from the US Bitcoin ETFs that we've seen in roughly 3 months. That put some pressure on Bitcoin. We've also seen fears linked to the potential for governments in the US and Germany to sell off a lot of the cryptocurrencies that they've seized from criminals in the space. That could also create some pressure. There have been a lot of bankruptcies playing out in crypto over recent years, and it looks like some of those tokens will now be sent back to creditors who in many cases have been waiting on their funds for many years. That could create more selling pressure. And I think finally there's also, just as you mentioned, a sort of a sense that the pro-crypto overtures from Donald Trump that we've seen in recent weeks, he's been speaking at Bitcoin conferences, promising the potential for Bitcoin stockpiles and things like that. There are fears that it just hasn't created the sort of momentum that crypto traders had hoped for.
Ryan, thank you. Ryan Weeks there, senior crypto editor, watching, of course, what's been going on here this morning. Of course, you can also turn to your Bloomberg for more on this. T-Live Go. We have plenty of commentary and analysis that's opened up here this morning, just given how much volatility is coming back into these markets here. Our expert editors are really working this morning. Feel free to check it out. This is Bloomberg.
Bond markets has been reflecting people's fear about the recession. From my view, I also would agree if Fed should employ a rate cut. I would expect one or two more cuts in November and December.
The pressure is growing, especially from what we see in the labor market. But however, whether this really overplayed by the market, I think this is also one of the questions they will have in mind, because if you look at the services sector in the US, it's actually not as worse as it looks on the surface.
Some of our guests are reacting to the market rout in Asia this Monday and weighing in, of course, of what the Fed's going to be doing here moving forward. Let's bring in Tony Sycamore, market analyst at IG Australia. Tony, it's always a pleasure to have you on, especially on a day like today. I mean, obviously there's been bloodshed everywhere, but, when you look at the price action so far, what do you think is really driving this sell-off?
We haven't seen a day of carnage like this really since the COVID sell-off back in February, March 2020, just across so many different asset classes. And I guess if we think about the straw which broke the camel's back, we had the BOJ last week hiking rates. We obviously had some very weak data coming out of the US, the ISM manufacturing, and of course the non-farm payrolls. And you've gone from having a narrative around a soft landing to all of a sudden fears of a hard landing or a recession, coupled with potential geopolitical tensions in the Middle East rising potentially leading to a more broader base conflict there. And as I said, what started as probably isolated moves in Japan in dollar yen, a little bit of profit taking in the Nasdaq after a wonderful move higher starting from probably mid-July, that pullback commenced. We're now seeing it spread more broadly across all different asset classes. I guess in terms of what can stop the bleeding, I do see tonight's ISM services PMI as being crucial, because last month we saw that drop from 53.8 to 48.8. If we were to see another decline tonight, then you probably have confirmation in terms of what you're seeing in some of the other data there, that potentially the cool landing narrative has shifted to a harder landing. And I do, when I'm looking at expectations out there for the ISM services PMI, there is an expectation it does push back above 50. So potentially if we can see that rebound back above 50, potentially we've seen the worst of it in this session in Asia, but a lot is riding on tonight's data in the US. I cannot overemphasize that.
Powell still indicated that he was open to cutting rates in September. So do you think really that the Fed has missed the window here to execute a soft landing, or is it just a little bit overblown, perhaps, the market action?
Yeah, there's certainly concerns that he has fallen behind the curve there. I probably think now he can still get back ahead of the curve with a 50 basis point cut in September if the situation warrants it closer to that time. But at the moment, we have to be mindful that they have put a lot of emphasis on the labour market data. We have to be mindful that position was very much well skewed one way in a lot of markets. So we can still look back and say this has been a position flush. But again, it depends on the data which comes in over the next month or so, and that starts with tonight's ISM. We know that the ISM does reflect in terms of the services sector. It is partly to do with what's going on with the consumer, with what's going on with households, which makes up over 2/3 of US GDP. So I am just hoping we don't see that crack widen tonight, because if it does, any chance of the I guess the reaction we've seen starting to calm down pretty much what goes out of the window, and it does accelerate. And all of a sudden, a 50 basis point optional rate hike looks more like a necessity.
Yeah. How do you look at this? I mean, how does it change the playbook if, in fact, we continue to see weaker data from the U.S. right now? What's the best asset class to express it? Is it still to sell tech stocks? Is it really basically, flocking to Treasuries? What's the best play right now, you think, Tony?
I think so. I think it's really a stock, not a great climate for stocks, whether it's tech stocks or small caps. I do think you're going to see broader based interest in getting into that fixed income space. Even now we're seeing, they're still attractive. Yields are still attractive, given where they've come from and where they've been. So, look, I think that's where there is more scope to move. I guess the other area or the other reminder we've had over the last 7 days is Bitcoin. You'll have people telling you it's a safe haven, that, it's going to withstand some of the volatility in markets. But what we've seen over the last week is just a reminder that Bitcoin and crypto is a risk asset, and it sits at the pointy end of the risk spectrum. So I wouldn't be looking to shift funds into that area. And of course, when you talk about the Ethereum ETFs and the Bitcoin ETFs, a lot of the people that have invested in these spaces since the start of the year, they've seen plus 10%, plus 22% week type things, but they've never seen anything close to a 15% down week, which we saw last week. And that's where you start to wonder, how committed are they to the cause?
What about within equities? Because you've seen that rotation away from big tech. You mentioned small caps. We went into defensive plays or dividend plays like utilities. REITs are a focus. Where do we go to next, do you think?
If this does become broad-based risk off, then your defensive sectors will do well. Utilities, your healthcare, etc. I'm not completely convinced this isn't part position wash. Part of what we see seasonally in August and September. I thought we'd probably see a kick up in volatility after the Olympics, but the market just couldn't wait. It got all one way, and we know that the Northern Hemisphere summer, particularly in Europe, I've worked at a French bank where you can send an email in June and you don't get a reply until August. So potentially some of the traders in Europe are going to now start to turn their attentions to markets more broadly. It's a great time to be in Europe. All our friends are on holidays in Europe, as we can see from Facebook, but I don't think they can ignore what's happening here. So August, September, a tough time of the year, and I think you probably need to be mindful of that. People that were probably not really wanting to commit to losing their positions are now going to have a very good hard think about what they do with it.
Tell us what you think is, the sentiment is so it's so extreme. I just wonder, is this something of just of a reset, given just how, frothy this market was? Do valuations finally matter, in particular when it comes to some of these big tech stocks, Tony? And or really, are you starting to see signs of panic right now? I mean, where are these dip buyers right now?
I don't think they're going to. You've got probably looking for signs. You want to see signs of capitulation. You want to see signs that people are starting to put their hands up. The Nikkei, for example, starting to recover after an early sell-off. And you think about where the Nikkei got to below 34,000, that's got to start to look a little bit attractive in my eyes here. Given the fact that the jury's still out, we are having a hard landing. So that's something to keep in mind. We're back to levels we haven't seen in a long time, really, since the middle of last year for the Nikkei. So if you've missed that run and you still like the outlook for Japan, which you probably should, then there's some opportunities there as well. So that's something to be mindful of as well. ASX 200 locally, well, that's not really rallied as hard as some of these other high beta markets. Here in Australia, it's down 5% at this point of time. But again, it's not rallied. So there is certainly, Yvonne, an element of position flush out there that we just got all too far on the wrong side of the boat, and now we're going back to the other side. It's like the rate cut, also the rate cut question with regards to the Fed. This time 8 months ago, we were pricing in 6 rate cuts. We then moved back after the June FOMC back to pricing in just a little over 1. We're now priced for somewhere around 4 to 5. And I think if you asked most of your guests at the start of this year, how many rate cuts do you think we were going to get this year? I think probably most would have said somewhere between 3 and 4. And that's exactly where we are at this point of time. So, yeah, there is an element of position flush and liquidation as a result of that.
All right, Tony Sycamore there, market analyst at IG Australia. Thanks so much for your insights, and we'll have more ahead. This is Bloomberg. All right, taking a look at the GMM function this morning, and you're seeing a lot of red and black boxes. It tells you that that's an outsized move on a statistical basis here that you're seeing in equities in particular, really extending those declines that kick-started last week. Concerns really around the Fed, where it goes next. Has it missed the window on a soft landing? Nifty futures trading as well.